As retirement advisors here at Reap Financial, one of the most rewarding things we get to help families do is spend and enjoy their wealth. By building well-designed and coordinated plans, our clients, they spend confidently. They cut the check with confidence, and it's powerful. You'd be surprised, a lot of families, a lot of retirees that have significant wealth, they don't spend it. One, because maybe they're scared or they're concerned that they'll run out of money, and oftentimes that's because they don't have a well-designed plan. One of the things we see a lot of successful retirees do is they buy a second home, a vacation home, something to that extent. There are some really simple ways to go about doing this in the best manner. So today I want to talk to you about tax-wise ways to get into that second home. Hey everybody, Chris Heerlein here, CEO of Reap Financial. Great to have you with us today. I drop new content every Wednesday on this channel. If you like what you see, hit the subscribe button down below. All right, are you considering buying a second home, vacation home? Well, there's some tax-savvy ways to do this that you want to be aware of. When you think about the second home, you got to ask yourself, is it going to be the vacation home or is it going to be the primary residence? See, there's a lot of benefits that come with one of your properties being homesteaded. When it's homesteaded, you often can lock in your property taxes after 65, at least on the larger school portion is locked in, but you need to consider a few things. The state in which you're considering buying the house, is there state income tax? And if there's not, is there higher property tax in one state or the other? Here in Central Texas, you could have your house paid off and property taxes, it's still like having another mortgage, right? So you got to think, if you were going to buy a second home and the property taxes were substantially less there, does it make sense to keep the homestead here or there? Well, if the property taxes here in Texas are a lot higher, it probably makes sense to keep the homestead here. Not in every case, but consider where you're going to homestead, tax perspective, tax efficiency. Now, when you buy a second home and you homestead it for that matter, what you have to think through is, how long am I going to live there? Because if you live there for 2 out of the next 5 years, it qualifies for the capital gain exemption. So the capital gain exemption is one of the best exemptions in the IRS code today. And as a single filer, if you sell a home that's your homestead, you can make up to $250,000 in capital gains and pay zero tax. As a married filer, $500,000 in capital gains on the sell of that home, no tax. It's an incredible gift. There's a couple things there. If you are living in the home and your spouse were to pass away, you have 2 years to sell the home and still capture the full $500,000 exemption as you were married. After 2 years, it would go back down to a single at $250,000. So there's a little caveat there and something that is often overlooked by widows. Also, the thing about this homestead exemption is you think about the purchase price of your home. That's your basis. Then you got any improvements that you put in the home through the years, swimming pool, new roof, all improvements. And then you've got your $250,000 or $500,000 exemption on top of that. That is how that works. Anything above that would be taxed at 15 or 20% cap gains rates as of 2024, that is. If you got a rental property now or a vacation home now and it's highly appreciated, a great tax savvy way to get into the new one is doing what's called a 1031 exchange. These have been around for some time. It allows you to take the basis and all the gains you've had in the property and identify a new property that's a like kind of property. There's some other rules around this, but it allows you to sell the property, go put it in a new vacation home, and at that point, if it's done correctly, it's likely tax-free. So a powerful tax strategy there with the 1031. All right, here's a great strategy and something that you do not want to miss because it can save the family tens of thousands, if not more, in taxes. And it's what's called a step up in cost basis. So I'll give you an example. If you're going to leave your home to your heirs, son, daughter, whomever, think about this. You bought the house potentially for $100,000, and now through the years it's grown to $1 million. Okay? If you were to sell the house, you're going to have to pay taxes on a portion of that appreciation. But if you were to pass away and leave it to your heirs, the day of your passing, they get a step up in cost basis. So they inherit the house, this $1 million home, and more than likely they don't want the home upon inheritance, and they sell the house for $1 million. In that example, they'd pay little to no tax at all. So a big problem that we see that gets overlooked is the parents are getting older and the parents say, well, I'm going to leave the house to you anyways, so what I'm going to do is go ahead and put your name on the deed. I'm going to give you the home today. Bad idea in most cases, because if you do that, you're losing the benefit of the step up in cost basis, because when your son, daughter, friend, family member sell that house down the road, any appreciation that has been seen on that since you've gifted it to them, they're going to have to potentially pay tax on as well. So in a lot of cases, things that seem to make sense on the back end from a tax perspective can really hit you hard. When it comes to second homes and real estate in general, there's a lot of gotchas, and one of the last ones that you got to be aware of is when you sell a highly appreciated home, when you have capital gains, those capital gains count towards income on your tax return, and this can spike your Medicare premiums dramatically, and it comes out of nowhere. And it can cost, hundreds if not thousands of dollars more through the years in Medicare when you have one of these spikes. So this is why we encourage families, if you have a big financial decision, purchasing a home, selling a home, you always consult with us first. Let us be part of helping you make very smart, educated decisions. What I want you to do is get your hands on my Tax Explorer report. It's at no cost. It's updated here for 2024. Email me right now, retire@reapfinancial.com. It's retire@reapfinancial.com. My team will have it on its way to your inbox.